Okay, in this video we're going to look at how businesses go about recording their transactions when someone runs a sole proprietor or runs their own business, and looking at what's meant by key terms like assets and liabilities and owner's equity. So first things first, when you're pitching a business, so for example, if you've ever watched the show Shark Tank or anything like that, they use a whole range of different figures to pitch, I suppose, how viable their business is as an investment opportunity. So some of these things here, like total assets the business owns, how much revenue they make, how much profit they make, what their equity in the business is, how much debt the business is. These are all top issues that businesses face and things that you need to talk about when you're pitching a business. So in these videos, we're going to look at what each of those means. So the role of an accountant essentially is to give business owners information about the state of their business. So they want to tell business owners whether that business is making a profit or a loss, how much the business is worth to the owner, how the business compares with other businesses, how much they owe to the creditors. So creditors are other businesses that we owe money to. So for example, we may have purchased stock off them in the past and not paid those businesses, so we owe that business money. We may have loans to the bank as well. Basically accountants tell the business lots of information about the state of that business at a particular point in time. So in this video we're going to look at the main sort of what's meant by assets and liabilities and owner's equity when running a business. So first things first, assets. Assets are all the things that a company owns at a point in time. They can be tangible or intangible, which means they're generally physical items you can touch, but they can also include intangible items that you can't touch. And the idea of these assets is they're designed to provide some benefit to the company in the future. So examples of assets, a building would be an asset for a business. Debtors, so debtors, the term debtor refers to a customer who's purchased stock on credit or purchased, basically you provided a service for in the past but they haven't paid you yet. So anyone that you provided a service to that is yet to pay you is a debtor, and they're an asset because when they do pay you, they're going to bring money back into the business. So they're considered to be an asset for that business. Stock, so any sort of inventory that you have or anything that you've got ready to sell is an example of an asset. Machinery, so any machinery you've got, any equipment that you've got on hand, any land, and any cash you've got in your business as well. So this is all on behalf of the business. Any physical items that they own at a particular point in time are included in their assets. And these assets are used to try and generate profit in the future. Then businesses have what we call liabilities. So liabilities are basically what the company owes to other people outside of the owner. So they will result in basically as paying money or outflows of money from the business in the future. And that can include any money that we owe to the bank. It can include our money we owe to our creditors. So creditors are people that have provided us with stock or provided us with a service in the past and we haven't paid them yet. So it's basically other businesses that we owe money to. It can also include what we call a bank overdraft. So when our bank account has a negative balance in it, when it's positive, it's an asset. When our bank account has a negative balance, it's called a bank overdraft and it will be referred to as a liability. So we've got our assets, the things that we own at a point in time, our liabilities, what we owe to other people, and then we have what we call the owner's stake in the business. So it's basically the owner's share of the business after we pay back all our debts or our liabilities. And owner's equity is equal to all the assets of the business minus the amount of liabilities. So essentially, if a business has got all these different assets that equate to, say, $500,000, but they owe the bank $200,000 and that's their liability, then they would have owner's equity of $300,000. So the accounting equation states that our assets are always equal to the total of our liabilities plus owner's equity. So basically what that means is that all the assets the business owns is equal to what we owe other parties or external parties plus the share of the owner. So all the assets are either owned by external parties separate to the business or owned by the owner himself or herself. Owner's equity, the owner's share in the business is equal to the assets minus the liabilities of that business. So for example, if a company has assets of $10,000 and liabilities of $4,000, then proprietorship or owner's equity, they're the same thing, would be equal to $6,000. If liabilities are $12,000 and proprietorship is $4,000, so those two add up and would equal to the total amount of your assets, which would be $16,000. If assets are $10,000, proprietorship is $5,000, liabilities are $5,000. This one here, assets, is equal to proprietorship plus liabilities. assets are 5,000 and liabilities are 3,000, then proprietorship, which is assets minus liabilities, would be equal to 2,000. Or if we use this equation, assets are 5,000, liabilities are 3,000, so owner's equity is 2,000. When we're looking at a balance sheet, we're looking at all the assets, liabilities, and owner's equity at a particular point in time for a business. So this is looking at Brad's hairdressing salon. On the left-hand side, we have all the assets of the business. On the right-hand side, we have all the liabilities, or all the money that they owe to external parties, plus what the business is worth to the owner himself. So once we've got our assets, which are 37,560, we minus our liabilities, so the amount we owe others, which is 9,350. The rest, the 28,210, is the owner's share of the business once he's paid back his liabilities or her liabilities. Okay, so if we look at this example, this is a balance sheet as of the 30th of June 2013. And then a business will start to make transactions which will affect the balance sheet. Any transaction that a business makes will affect the balance sheet. So if we look at this first transaction, on the 1st of July, the following transaction takes place. We purchased hairdressing supplies on credit, which means we're going to pay for them in the future, from MRAG for $500. So that means we're not paying cash, so it's not affecting our cash balance. But what will happen is that our asset, hairdressing supplies, on this side of the balance sheet is going to increase by 500 because we purchased more. We've now got more of an asset. But we're going to have to we now owe this creditor MRAG an extra $500 as well. So once the transaction is accounted for, our hairdressing supplies goes up to $2,000, but our creditor MRAG also increases by $500. And therefore, as you can see, after this transaction, the balance sheet is still in balance. After every transaction, the balance sheet will remain in balance. Second transaction, we sold some equipment and fittings worth $2,000 and used the money to pay back the bank overdraft. So if we go back to here, this is our equipment and fittings at this point in time, and this is our bank overdraft. If we sell $2,000 of that, that's going to go down to $5,000. We use that money to pay off the amount we owe the bank, but we only owe the bank $1,000 and we're selling $2,000 of equipment. So once we sell that, we're now going to have more cash at bank. An extra $1,000 will now be in our bank account. So in terms of the impact of that transaction, equipment and fittings would decrease by $2,000, cash at bank increases by $1,000, and the bank overdraft decreases by $1,000. So we pay this off first with the money we get for the equipment, and then the rest of it goes to a positive balance in our bank account. So overall assets decrease by $1,000 because equipment goes down by $2,000, but cash at bank goes up by $1,000, and your bank overdraft goes down by $1,000, which keeps us in balance. And therefore, if we look at this transaction, you see now we've got cash at bank of $1,000 instead of a bank overdraft of $1,000 here, and equipment and fittings is $5,000 instead of $7,000. Now that the business has money in its bank account, it will be able to pay off some of its debts. So on the 3rd of July, we pay $800 off the balance owing to MRAG. So that will decrease our bank account by $800 because we're paying him money, but it will also decrease our creditor MRAG by $800 because we don't owe him as much money anymore. So again, if you look at this here, these are the initial balances. You've got bank of $1,000, you've got a creditor of $1,350. When we pay them back the $800, bank goes down to $200 because $800 has been taken off, and the creditor MRAG goes down by $800 as well because we don't owe them as much, and therefore they're no longer a liability, or 800 of it is no longer a liability. Transaction D, the owner contributes capital. When you see the word capital, that's the owner contributing either his own funds or his own assets to the business. So, for example, if you contribute cash, that would increase cash. If you contribute a piece of furniture or equipment or a car, that would go into an asset as either car or equipment or furniture. So if you contribute $500 in capital, cash at bank increases by $500. Owner's equity capital increases by $500. So any contributions made by the owner, and this will always be specified really clearly, will always increase owner's equity or the owner's share of the business. So in this case here, the bank account increases by $500. It was $200, and you record the rest of it as additional capital in our owner's equity of $500 as well, which keeps our balance sheet in balance. Whenever the owner withdraws money from the business, this is referred to as drawings, and it's taken out of owner's equity. So if we withdraw cash, cash would go down, and you take it away from drawings in owner's equity. So for example, on the July 5th, we withdrew $200 for personal use. bank goes down by 200, and drawings on the other side goes down by 200. So again, here your bank account would go down by $200 from 700 to 500, and you would have this figure called less drawings, and that would be a negative figure, so it should have a minus 200 in front of it. And again, because both sides have gone down by 200, that would cause our balance sheet to remain in balance on both sides. Thank you.